You're listening to Sound Money from Casey Research.
Hello and welcome to the show with me, Andy Duncan, in London. Today, my very special guest is John Mauldin, who is president of Millennium Wave Investors, founder of Mauldin Economics, and editor of Thoughts from the Front Line. Today, he's in Dallas, and we'll be talking about his recent book, Code Red, Central Banking Practices, and how investors should position themselves in face of a potential coming crisis. Hello, John.
Hey, it's always good to be with you, Andy.
Fantastic. Now, since 2008, we've been living in a code red world where central planners inside central banks have papered over one crisis into another to help avoid the banking industry collapsing. Did they need to do all of this papering over, or should the central banks have just let everything go in 2008?
Well, the answer to that is yes, they needed to do some of the papering over, and they shouldn't have let things go in 2008. Now, do I like the way that they stepped in and what they did in 2008, 2009? The answer is absolutely not. They should have let shareholders of banks collapse. They should have restructured banks. They were right to guarantee deposits. They were right to flood the markets with liquidity. That's the purpose, and perhaps the only purpose of a central bank, or the most significant. Now, maintaining stable money would be appropriate if they would do it. All the other things that they do where they feel responsible for the economy and employment and markets, that's not something that they can actually change in the long term. They can mess around in the short term, but the problem is then you're messing around with the fundamentals of the economy, and you're suggesting that in the case of the Fed, 12 people sitting in a room or 27 people in Europe, or however many governors there are in England and Japan, that they can sit and make the appropriate decisions as to how to structure interest rates and valuations and so forth. And the answer is it's always short term, and you're messing around with the fundamentals, and we don't truly understand what that means. For instance, when we decide we want interest rates to be lower because we think it's going to help employment and that it will encourage investors to take more risk, and that will help improve asset prices. Well, that does in the short term, but we don't know what the long-term effects are. We do know that it is, in essence, it's trickle-down monetary policy. It makes bankers and stockholders wealthier for the short term, no question about that. But it also punishes savers, and it sends the wrong signals throughout the marketplace. So you have people doing things for financial reasons, i.e. buying stock back when they can borrow money so cheaply, rather than doing things for productive reasons. The central bank operates under a theory that consumption is what drives the economy. And you can make a really good case for that. The problem is if you try to stimulate consumption with leverage in a market, in a climate, and an economy that's already over-leveraged, it's like giving your alcoholic the answer in the form of another fifth of whiskey. It just creates more of the same problem. Then there's the follow-on problem of when they put this money into the system, it has absolutely created boom and growth in markets, just not where they wanted it to happen. It happened in the emerging markets. That's where all the money went to, because that's where the risk and the leverage and the opportunity was. We had a low rate return world, so people took their money to the emerging markets. Now that they're beginning to taper, we're watching what's happening today. Money is fleeing out of the emerging markets. It's having a knock-on effect to the developing markets. And so what they were trying to do for a short-term effect ended up having longer-term consequences that we've got to work through. And that's the problem with code red policies. We've put the patient on morphine when it was appropriate to do so, this being the US economy, the European economy, they came into the hospital, into the emergency room, and they were on their deathbeds. And we had to stabilize them and get them out of their pain. And that was appropriate. Now, we didn't take them off the morphine. I mean, today when you go into the emergency room, you go get your knees repaired or you get some procedure done, they're taking you off the pain medicine as quickly as they can. They're getting you back up and walking. They replace your hip and they have you walking the next day. I mean, and it's painful and you hurt and they say it's good for you. Take your medicine. We didn't do that to our patient, to our economic body. We kept them on morphine, and now we're saying we're going to try to take it away. We think the economy is in good enough shape, and the market's just throwing up. It's having a taper tantrum.
So you talk about morphine there, and the traditional kind of cure for morphine addiction was always a cold turkey. Now, we've just had Janet Yellen lowered into the Fed chair, who's a kind of Bernanke too. Do you think we should have gone cold turkey with more of a Volcker figure?
Well, yes, but that's not going to happen. That's not reality. Quite frankly, we don't need to go cold turkey. We don't have 15% unemployment rates. Tapering is fine. I'd like them to do a little faster. A group of people cannot manage an economy of billions of people. They just don't understand it. We don't have the tools. We don't have the knowledge. Our models are incomplete. And so to attempt to try to do so, it's a massive amount of hubris. And the unintended consequences, as we were talking a while ago about effects in the emerging markets, to the point where you have the governor of the Bank of India, who is US trained, he's one of the most respected academics out of the University of Chicago, basically doing a throwdown to central bankers and saying, you guys created our problem and now you're telling us to deal with it. Well, he says, we are going to deal with it, but you may not like what we do. And he's talking very clearly about some kind of capital controls. You know, to most libertarian free market lovers, you say the word capital controls and they go, oh my God, that's evil. And the answer to that is a nuanced, well, maybe not. If you are investing in a hedge fund, say, that is making 4-year loans, and they can leverage up a little bit, so you can make 12 or 13% on your money on 4-year loans of very, very high quality loans. Well, if you're borrowing short-term money to fund it, then you've got the risk of what happens if everybody wants their money. Your loans are still good, but if you have to sell them at the market, and by the way, you only ever have to sell when things are really bad. You never sell when things are good. Then you lose a lot of money on what should be good investments. Well, if you're in that fund with people who are also locked up, so you all have 4-year time horizons, your time horizon matches the duration of your investment, well, then you're much better off and you can ride through market up and down and ups and downs and get your money. Well, what Rajan in India is saying, guys, you brought all this hot money in, you did all this stuff, and now you want to take it out, and you're collapsing our economy. What we're going to try to do is to match our duration risk with our investment time horizon. So you look at 2 economies that are not having a cash flow crisis right now, or I can think of 3, Chile, Brazil, and China. And they're not having an international cash flow crisis. They may have their own problems for different reasons, but they had capital controls. So the hot money didn't go in, and the hot money doesn't need to exit. And the rest of the world is looking at that and going, maybe we need to have, if you're an emerging market, some types of capital controls. And as I hinted in my letter this week, I didn't hint, I said, that maybe one of the definitions of the way we look at what's the difference between an emerging market and a developed market, it may be whether or not you need capital controls. For instance, the US, I can't even think of a situation where the US would need capital controls. We're just too big. Money's coming in and leaving every day. The same thing with Canada, the same thing with England. We don't need capital controls. If you are a smaller country, if you're developing, if you can't handle the hot money, because the hot money comes in and always wants the glamorous projects, and they want to make a lot of money, and they're not ready to invest with you long term, it's going to create a problem someday. You want to invite money in. You want to be able to guarantee your investors we're not going to have inflation. We're going to give you a stable environment. We're going to give you what George Gilder would call an entropy-free bandwidth market. We're going to give you the rule of law. We're going to give you a stable economic and inflation environment. And all that we ask you to do is to invest with us longer term. Don't be short-term money. Don't be coming and trying to make money out of our market and then leave with us holding the bag with having to pick up the pieces. I think you're going to see more capital controls in emerging markets, not less. And it means that investors are going to have to become more long-term focused when they go into these markets, not less, which I, by the way, think is appropriate for both the investor and the country. If you want to be a trader, and I have lots of friends who are traders, God bless you, go trade. That's not the best thing for most people. Most people are investors, and they want to see a reasonable appreciation of their money over time. They want to see their money grow. Now, we all love to see it grow 20% a year or 40% a year as opposed to 2 or 3 or 5. That's just not realistic. We should try to be opportunistic, and when we get the opportunity for something that's higher growth, well, great, let's tie our money up and do it. But we need to think of our money in terms of more significant time buckets. I've got my long-term money, my really long-term money, my medium-term money, and here's my money I need over the next 2 or 3 years, so it's got to be fairly liquid. And that may be a lot far afield from where we started, Andy, but that's kind of how I see things right now.
Coming back to this hot money idea, once a central bank holds its nerve and really does stop printing money, one of the usual consequences is that there's some kind of a bust when an overinflated bubble collapses. Now, we've seen US stocks fall in the last month. Do you think this is the beginning of such a bust, or is this bust going to come in something more like bonds or something else?
My gut tells me that this is a cyclical bear market of some kind. It'll draw back, it'll find a bottom, and then it'll begin to grow again. And we'll reach new peaks and more people will get sucked into the market. And we'll keep seeing that cycle replay itself. I mean, recognize we haven't had a decent correction now for like 18 months. It's a reasonable correction. It's way overdue. The big correction is awaiting some type of future crisis, is awaiting some type of future event. And then I think we'll see that 40-50% market correction from whatever point we're at. If you personalize it and use an inappropriate anthropomorphic analogy, Mr. Market tries to figure out how to create the most pain for the most number of investors. And I think a couple of rallies and sucking people in on the buy the dips would do that, because then that'll get people saying, hey, let's just deal with some volatility. And instead of dipping 10 or 15% down, it just keeps on going. And that's how you create the pain.
Do you think this situation could be one of those potential crashes, or is it just a 15% slide before it recovers?
My gut tells me that it's one of the more temporary ones, because I look around the world and I don't see a true crisis. Now, maybe this emerging market issue turns into be 1998. But if you remember, 1998 was a serious bear market. It, brought down a few big hedge funds and some other problems before the market promptly turned right back around and went up to ridiculous new highs. My gut tells me that we're looking at something more like that. I mean, we could certainly see another 10% sell-off from here. I mean, today we're looking at the market dropping another 2 points. As corrections go, if the market turned around today, this wouldn't be all that significant a correction. I don't think we've seen the bottom in this particular shorter term cycle, but I think we've got some tradable turnarounds here before the market truly hits a reset value and we see the end of the long-term secular bear that started in 2000.
Now, again, if the Fed does taper down to zero and stop artificially kind of interfering with interest rates, we'll get a natural interest rate. Let's just say for the moment that's 5, 6, 7%. Banks might then start lending their excess reserves, and this could increase the monetary velocity. Do you think that this could be a problem, or will it just mean that we'll get a normal market again?
Well, I don't think that rates in the short term go back up to a normal 5 to 6%. We're still in a deflationary, deleveraging world. They go up some, but I'm not certain in the world we're in today that short-term rates are anywhere near north of 3%. But that being said, the banks have lent a great deal of money to people who can pay it back. When I talk to especially the small and regional sized bankers, they can't find enough good quality loans. If you look at the National Federation of Independent Business survey, something like 93% of their members have all the financing and loans that they want. They're not out there pounding the door complaining about we can't get bank loans. The money's out there if you want it, and you can demonstrate a way to pay it back, and if you need it. There's just not a lot of pent-up demand. So I don't see what's going to turn that back around again. I mean, the velocity of money began to fall in the middle of last decade, way before the crash. What made it slow down? Well, you know, the part of it was demand for loans. Part of it was people were leveraged up. I think typically these things go in decade cycles. So we're probably, I mean, we could see the velocity of money turn around this year, but that would be a relatively short turnaround, a relatively short cycle. Now, if you look at the chart at the St. Louis Fed, it looks like we're pretty much close to, the lowest on that chart, which only goes back to into the 50s. If you go back into the 30s, in the last truly deleveraging cycle we had, the velocity of money got significantly lower than it is already today. It's hard to say, but I don't think rates are going to rise that much. It wouldn't surprise me that 10-year is going to be down on the year, which is not what a lot of people are thinking. But that's the nature of the cycle we're in.
Okay, what you've described is quite a volatile situation. It could go one of several ways.
Oh, absolutely. The problem is, Andy, we're in an experimental period. The central banks of the world are experimenting on our economic body without benefit of anesthesia. They haven't done this before. We've never seen the world's reserve currency, central bank, decide to stick in $1 trillion into the world economy and then decide to say, okay, now we're going to stop putting that in. We don't know what that does. We truly don't. I can give you a stack of research papers that says it's going to do nothing, and I can give you a stack of research papers that says it's going to break all hell loose. And they're all working off of this theory or that chart. The simple fact is we don't know. Now, if you held a gun to my head and said, choose, I'm going to choose the one that says it's going to create the problems. I think it creates a problem more from what I call the narrative, more from the story side. I mean, the market shouldn't be responding to the difference between $85 billion of QE and $65 billion of QE. It's still massive amounts of QE. It's now only $750 billion a year. Why? I mean, I just get mystified. Why is somehow another only $750 billion not enough to keep propping markets up? Well, it's because of the narrative. It's because of the story, because the market's looking forward to the day when there's not any, which means that that's going to be the day when the Fed is going to start raising interest rates. Oh my God, do I want to be in the market? Maybe I should position myself. And these things take lives of their own that shouldn't, in theory, on paper, have much difference. So thus you get the research papers saying that it won't make any difference because they're looking at, what really happens in the marketplace as opposed to the momentum and the emotion which drives the marketplace.
Now, if we don't know what's going to happen, and I love looking at that chart from the Fed, which shows their assets going up very slowly over 50 years and then tripling from 2008 onwards. If we don't know what's going to happen, you've written the book Code Red to help investors decide how to protect themselves. Can you explain in just a very short nutshell what our listeners should do from the advice you give them in Code Red to protect themselves over the next 5 to 10 years?
A lot of it's standard. You do have to be diversified, but you want to make sure that your diversification is true diversification. Simply being diversified among 10 countries when the world is running out of stocks isn't helping you. You need to look for income-oriented investments. We're in a secular bear market, or we're in a deleveraging world. Right now, this isn't the time to take a great deal of risk. You want to grow your money slowly. Bank loans, if you have access to be able to participate in a basket of those. Other things are real estate that's true income real estate with solid tenants. It's not speculative real estate. I mean, there are places to make money, but you have to do it judiciously. You need to hedge your risk among styles as much as anything. If you have a 60-40 portfolio, which most people have if they're with a traditional broker, I mean, they'll say we are this and that, but at the end of the day, when you do an analysis on the underlying portfolio, it looks really close to a 60-40 portfolio. That means you've got 90% of your risk concentrated in equity markets. That's not diversified. You need to figure out how to diversify your risk. You need to recognize that there are different styles of investment that have different risk characteristics. So maybe diversify among styles now. Do your modeling based on that. I mean, we're starting to do some of that ourselves in our own research here at Mauldin Economics, trying to figure out how to help clients make it through this next process.
Okay, and what's been the reaction to your book?
Oh, it's been quite good. The book is selling steadily. I mean, I think it's in the third printing. Rand Paul quoted from it in one of his Senate speeches. Been getting very, very good reviews. I'm very pleased with it.
Well, it's been fascinating talking to you today, John. How can our listeners find out more about your work?
Go to Mauldin Economics. Just Google John Mauldin. It'll take you to Mauldin Economics. Give me your email address. We'll send you my 2 letters that I do regularly for free. I do one every week, and then I feature somebody else in the conversation. And then all of my associates and partners will give you opportunities to work on that too.
Well, it's been fantastic listening to your narratives today, John. Thank you very much for your time.
Thank you, Andy.
You can subscribe to Sound Money on iTunes or sign up to our subscription service at soundmoneyshow.com, where you can also listen to our growing catalogue of podcasts. Thank you very much to John Mauldin today for joining us on the programme, and thank you very much for listening. Until next time, goodbye.